Oil rose. Treasury yields rose. Stocks rose too. That combination is not impossible. But it breaks the one-factor story many people use to explain markets. Higher inflation pressure can hurt valuations. Stronger earnings evidence can support the cash flows being valued. This week, both forces were visible at once. So why did stocks rise? Not because inflation vanished. Not because yields stopped mattering. The market temporarily priced competing evidence at the same time. Use the common 5-day hourly window ending July 31st. West Texas crude rose roughly 2.3%, from about $84.82 to $86.80, after covering a high-to-low range of more than 10%. The 10-year Treasury yield rose from about 4.65% to 4.75%, an increase of roughly 2.1%. TLT, the long-duration Treasury fund, fell about 1.7%. That confirms the bond side of the story. Yields rose and long bonds paid the price. Yet the Nasdaq 100 gained about 1.3%, and the S&P 500 gained about 1.1% over the same window. The policy backdrop did not make that tension disappear. On July 29, the Federal Reserve held its target range at 3.5% to 3.75%. The statement said inflation remained elevated, partly because energy supply shocks had raised prices in some sectors. Free voters preferred a quarter-point increase. That is not a soft inflation message. It gives the rise in yields a coherent macro explanation. Oil pressure was visible, the Fed acknowledged elevated inflation, and the bond market demanded a higher yield. If that were the only force in the market, growth stocks should have struggled. They did not. That brings us back to the thumbnail question: why did stocks rise? The missing side is cash flow. Associated Press coverage of Friday's market pointed to strong results from Amazon as one support for the equity rally, even while higher oil and Treasury yields kept inflation worries alive. One company does not explain an entire index for an entire week. But it demonstrates the mechanism. A higher discount rate reduces the present value of distant earnings. Stronger evidence that those earnings may actually arrive raises the cash flows being discounted. Valuation pressure on one side. Cash flow evidence on the other. Both can operate at the same time. The evidence supports a narrow answer. Cash flow support was strong enough to keep the headline indexes positive, while TLT confirms that the rate mechanism was still working in bonds. The dollar adds a third piece. The dollar index fell about 1.5% in the same window, even as the 10-year yield rose. A simple hawkish Fed story usually expects higher yields and a stronger dollar to travel together. Here they split. That split tells us not to compress the week into a single label. U.S. yields reflected inflation and supply pressure. Large company earnings supported equities. At the same time, currency markets showed a sharp yen move alongside a different policy conversation in Japan. 3 mechanisms. 1 week. No single arrow explains the whole map. So how do we judge which force is winning? Start with breadth. AP's weekly figures showed the S&P 500 up about 1% and the Nasdaq Composite up about 1.6%, while the Russell 2000 was nearly flat. If resilience broadens beyond large companies, the cash flow story becomes less concentrated. If it remains narrow, the headline indexes can hide fragility underneath. Next, watch persistence in oil and bonds. One volatile week in crude can lift inflation anxiety without changing the longer trend. Continued oil strength alongside a 10-year yield holding near the highs would keep discount rate pressure active. Finally, watch whether TLT stabilizes while stocks remain firm. If long bonds stop falling, equities no longer need to outrun a worsening rate impulse. If TLT keeps sliding and market breadth narrows, the current balance becomes harder to sustain. None of that is a forecast or a trade instruction. It is how we can classify the evidence together. Oil up, yields up, and stocks up is not proof that inflation no longer matters. It is evidence that a market can absorb one pressure while another source of value offsets it. This week's price pattern is consistent with earnings support outweighing duration pressure in the headline indexes, while bonds still register the cost. The experiment is to watch whether that offset broadens, persists, or disappears. We will keep tracking which side of this contradiction gains ground. Subscribe for future weekend lab experiments. Daily observations are posted at Market Validation Lab on X. The link is in the description.